Hello there, this is tradingpedia.com, and this video refers to a topic very important in technical analysis. Japanese candlesticks patterns are known as mostly reversal patterns, and we will cover the hammer formation, the hammer pattern in this video. This is the euro and the US dollar on the daily time frames. And as I mentioned earlier, the hammer is a reversal pattern forming at the bottom of bearish trades. This is only one candlestick's pattern. It means that only one candlestick, all these green and red candlesticks that you see here, they are the basis for Japanese candlesticks patterns, either continuation patterns or reversal patterns. But the hammer pattern has only one candlestick. It has a small real body. The real body of a candlestick is the distance between the opening price and the closing price. So this is a bullish real body, for instance. This is a bearish real body. See, this is the opening price, this is the closing price. And whatever the market forms above the real body or below, it is called the upper shadow or the lower shadow. For the hammer formation, this is a hammer, for instance, let me show it to you. For the hammer formation, we need only one candlestick, this small candlestick here, the red one, only one candlestick, and it is characterized by a very tiny real body, not a line like it is here. This is called a doji candlestick, but something like this. To make the difference between a doji candlestick or another candlestick that looks like a hammer but is not a hammer, so to distinguish between the two, think of or do the following trick if you want. Measure the length of this real body and project it 2 times, minimum 2 times, into the length of the lower shadow. If it fits, then that's your hammer. If it doesn't fit, the pattern is not a hammer. It is just a regular candlestick. For instance, this one here, if it would form at the bottom of a trend, this would not be a hammer because you cannot fit twice the real body into the lower shadow. So that's the prerequisite, besides the fact that the market actually needs to be in a bearish trend. See here, the market declines for more than two trading weeks and remains at here. Now, the opposite of a hammer, so everything that we discuss here on the hammer, the opposite of a hammer is called a shooting star and forms at the end of bullish trends. On a bearish trend or on the hammer pattern, imagine that the market shows a battle between bulls and bears. Bears are in control, otherwise the market will not fall. But with the hammer formation, a bit of an optimism comes to the market as bears prepare to take control. To trade the hammer formation, this is the trading plan, or this is the plan for it. You mark the low of the pattern and the high of the pattern, either on a piece of paper or on a chart or whatever, and this would be the distance from the higher price to the lower price. Then you take a Fibonacci retracement tool to find out the 50% level and the 61.8 level. This is too small a hammer to use the tool, but the 61.8 and the 50% ratio levels will be somewhere around here. And this would be the entry place for a long trend. So to trade a hammer is not enough to wait for the market to close, or you should not trade right at the close, but wait for the market to come to 61.8 or to 50%, depending on how aggressive you are in your trading. And that would be the risk for the trade. This would be the risk because the stop loss must be at the lows here. Remember, the hammer formation as a reversal pattern shows a battle between bulls and bears won't take it for granted. They will try to push the market to a new low. Bulls, on the other hand, seeing this price action here, will try to buy some more at the start of a new bullish trend. So in order to apply a sound money management technique, one needs to use a risk-reward ratio of at least 1 to 2. Meaning, if this is the risk, let's assume that we risk $100 on one trade, or 2%, or let's use percentages, not dollars. You use 1% from the trading account on one trade, and then the reward should exceed minimum twice the risk. Ideally, or the higher the risk-reward ratio, the better for the trader. In this case, if this is the entry place and this is the risk, then if we project the risk to the upside 3 times, so one time would be here, another time would be here. Remember, this is the daily chart. Another time would be here. This would be the exit from the trade. Remember, this is the daily chart, so the entry would be 1.0787, exiting for 1.0840, a nice 1 to 3 risk-reward ratio. As always in money management, it depends very much the volume traded. Risking 1% of the trading account for 3% is a good risk-reward ratio, better than the risk-reward ratios offered by other classic reversal patterns, like the head and shoulders, for instance. So this is how you trade a hammer formation. Another hammer would be this one from here. For instance, the market in a bearish trend forms a hammer. If we measure the length of the real body and we project it to the downside 1 time, 2 times, and then we measure the entire length, its length from the highs 1274 to the lows 1188 or 1185, and then we use this 50% retracement as an entry. This would be the risk, and the reward would be the risk projected 3 times, 1 time, 2 times, 3 times, so you exit somewhere around here. Aggressive traders, what they also do when trading hammers or shooting stars, when trading hammers, aggressive traders, what they do is they go with trailing the stop every time the market puts a new level in the risk-reward ratio. For instance, if the market, this is the entry, and the market reaches 2 times the 1 to 2 risk-reward ratio, then the trader trails the stop to the next level. The market reaches the 1 to 3 risk-reward ratio, the trader trails the stop this time all the way to. So one more leg, or trailing the stop with the market's advance, is another way to make the most of aggressive trends like this one. But it is enough for any trade or for any setup to use a 1 to 3 risk-reward ratio, as the account will constantly grow. Thank you for being here, and on our next topic we will use the head and shoulders in contrast to how to trade the hammer. Bye bye.